All right, good afternoon, everybody. Welcome to today's Technical Tuesday. We're talking about VCPs. We're going to build out a model book for the volatility contraction pattern. Now, you might notice if you're looking at the screen that I inserted this right here. And I don't have any of the other part of our template filled out. This is actually a tab. If you go into any of the playbooks, you have this tab right down here for setups, and you could go and you could see the template that's here for each of the different setups that I look at. So I thought that it would be a good thing to start to fill this out together, so that way you have an idea of how you might want to go off and build something similar for yourself. If you want to take exactly what's here, you can. All you have to do is just go up to File, click Make a Copy, and then you'll have your own copy that you'll be able to edit and do whatever you want with. Um, but for this, let's get started with the volatility contraction pattern. So, time frames. These are all the different things that I want to see, and the volatility contraction pattern must have in order for me to consider it. Now, maybe you've read Mark Minervini's books, and maybe you've taken some of his courses. Some of you have even been a part of his service, or part of his service right now. Well, we have quite a few people that sign up for a bunch of different things. So you might be even more familiar with Mark's definitions than I am. So take what I'm putting here as not Mark's definition, but Mike's definition. And that's really the point, or one of the big points of you building out your own model book. It's not for you to have Mike's definition. It's not for you to have Mark's definition. That's the starting point. What you're eventually going to end up with is your own definition of what it is that you're looking for, and that's going to be your guide. And then when you have your models, over time those models will evolve and you'll be able to tweak it as you go. So yes, was there a question or a comment, Alberto? No.
Nope, not for me. No,
uh
thanks.
all right, great. So time frames. This is the what I mean when I talk about time frames is, where am I looking for this thing? So for VCP, I want to spot it on daily time frames, on weekly time frames, and I'll even drop down into the 30-minute time frame. Now, when I'm looking at the 30-minute time frame, and I have a few examples for us to take a look at. When I'm looking at the 30-minute time frame, I'm not starting there, right? So actually, why don't I rewrite this so that way it's in the order in which I would look, right? So the first place where I'm looking for things on the weekly time frame. If I spot it on the weekly time frame, I'm dropping down into the daily time frame and making sure that the price action is still there. It's still what I'm looking for, and we'll get into what I'm looking for in a moment. But then after that, that's when I drop down into the 30-minute. It's not starting at the 30-minute or hopping around and all there. There's a specific order to it, and for this particular one, that's the order. Length of bars needed for the pattern. For VCPs, right? So not having volatility contraction action, right? And Mark specifies this. It's something that I picked up from him too. I always want to see volatility contracting whenever I'm looking for a breakout. The difference between our entry price and our stop price, where we would look to buy a breakout and where we would place a stop below support. I always want that area to be nice and tight. That's the volatility contraction action. But the pattern is what we're focused on here. And so as
Real
far
quick,
as the
Mike,
yeah.
when you say this volatility contraction, you're talking about the candles themselves not being really wide, or you're talking about the point at which it like hits support and you see it contracting around that point or something
uh
like Can you describe what you mean by that,
Uh,
volatility contraction
yeah,
pattern?
uh, it'll be crystal clear as soon as I pull up the chart. In fact,
Okay,
after I say the length, we'll jump right over to some charts, and you'll see the examples.
cool.
So, as far as the length, I want this to have at least I'd say 5 weeks. 5 weeks or more. And the or more part, as you'll see, could be several months. So let's take a look at some examples here. I think the first example that I want to take a look at is Nvidia. And so Nvidia, we could start over here on the weekly chart. And we're looking down here. Right, and so Darren, let me know if this gets at if this part answers the question that you had as far as bars and candles. But over here, what I'm looking at is contractions of here's where price is moving sideways, and here is how price is starting to round out a pattern, and then that pattern is getting tighter, and then there's tighter, and so you could visually see, right? If I take off the annotations, you could still spot that there's a spot where price is wide and loose and moving sideways over here, and then it's contracting over here, and then it's contracting once more before it finally takes off.
Okay, yeah, perfect. Yeah, I see it.
All right, great. And the more of these that you see, the more your eye will be trained to spot them. So that way, if you just see it once, that's not enough, right? Because then too many things could qualify, like, oh, well, this is starting to contract over here. No, it's where we want to have a clear definition. We want to have many examples. And we also want to know, well, what makes one of the things that we're looking for, not just meet the minimum criteria, but what makes one, what takes it from good to great, right? I call them boosters. You could call them whatever you want, but that's a general idea, right? So 5 weeks or more. The one that we just saw in Nvidia here started way back in August of 23, and it broke out in January of this year. And this was one of the biggest winners of the year so far. Ran about 100% from that breakout. And it did that in the span of, what is that, between January and March. So 3 months.
I have a question about the pattern itself. So if you look at, I don't know how to look at it, but the first dip circle, the first half circle, it looks like there's two dips within that circle, but you have it as one dip. Oh, maybe you just did that. You know what I'm saying? Because like if you look at the contraction, it makes sense, right? But if you look at the start of the first circle, it's 1, 2, 3, 4, 5 bars, then it goes up, then it goes 1, 2, 3, 4, then it goes up, then it goes 1, 2, 3, 4, down, and then up.
Yeah,
and then 1, 2, 3, and
I was going to make the same comment actually, Darren, because to me that looks like, first of all, a double bottom base. Then as it continues, it looks almost like a flat base. So it's like difficult to interpret. You know what I mean?
Right. That's an excellent question. And so like that, so this is where I think that people start to get into trouble. This is where I started to get into trouble too when I first started to read Mark's work and was just like, well, how do you know to start over here versus start over here versus maybe you draw something out that looks like the double bottom and then you add this other stuff on, right?
Mm-hmm.
Yeah.
So part of the answer to that question is that the more of these you see, the more examples that we see, the more you start to understand the nuances of them, right? Because with VCPs, the definition isn't as, I'd say, simple as, say, a flat base, right? Well, where if you read O'Neill's book, the definition of a flat base is 15% deep, 5 weeks long, and that's pretty much it, right? And of course, you want it to be like the placement of accounts too. So you want it to be in an uptrend and above the 50-day moving average, ideally. But as far as the VCP goes, the main thing with it is that when you look at the left side of the chart and you go over to the right side of the chart, prices get the pattern is getting progressively tighter as you go. Right. Well, as well, we take a look at the examples in Netflix and in this other one, Green Brick Partners. I think that it'll look a little bit more clear. But I want to still fill out the rest of what we have here. So 5 weeks or more for the pattern itself. So sometimes that pattern that we just looked at happened to be several months. Sometimes you could have all of this, right? Just to flip back to the chart for a second. Sometimes you could have all that happening much quicker, right? Sometimes you'll have it in just a month and a half. That's why I'm saying 5 weeks or longer. Now, length of bars needed below the pivot. I like to have a minimum of 3. So I'm going to write a minimum of 3 days. Right? And that's just something that's unique to me. The reason why I like to look for a minimum of 3 days below the pivot is because it gives it time to reset. Here's what I mean. So if we come back over to this and we zoom in a little bit, this that line right here, and I thought that I had put the template on. The template that I have just makes it that same shade, but puts the word there. So I know. So this is the pivot. I want it to be hanging out below that level wherever I draw the pivot for at least 3 days, because then it lets me know that this is a point of resistance, that it's not something where price hasn't found much of a ceiling below it yet, where price, like sometimes if price is just pushing higher, like over here, if you say that, oh, well, price was below, I don't know, this or below this for 2 days, you could just end up buying in too many different locales, where if it's at least 3 days, it tends to work out to be a better pivot for me. But one other thing to tack onto this too, right? And let me know if you have questions at this, because I feel like I might be adding a little bit of murkiness to this.
I have a basic question, which is basically when you go back to the chart, there are like 3 or 4 waves until you have a major reduction in or 2 or 3 waves before you have a reduction in volatility. How many touches of the pivot line must there be?
So this is how the VCP, it doesn't really matter. Or it matters less about that, because this one here, all this contraction ended up being below this line that started way back here. In some of these other examples, and let's just bring them up so that way you could see them. Right, so this was Netflix. Netflix was similar, but with Netflix, you could have even drawn the line down here.
Mm-hmm. Okay, so there was virtually just one touch, and then it breaks out.
Well, if you drew the line from where my mouse is going across, do you see the mouse moving?
Yeah, various touches there. Well, it breaks through, and then it's sort of resistance line at the very end. it breaks out, and then it's like resistance.
Right. And the
Support.
reason why there's this resistance right here has to do with this back here, because
Right.
it's getting back to the former high and then breaking out.
Okay, so your early entry pivot later provided support for the true breakout. Would you say that?
Yes, but I think that we're getting a little bit ahead of ourselves here.
Okay, okay.
That's a common thing, though, is when resistance
Getting ahead of
turns into
ourselves?
support. No, the resistance turning into support. But yeah, the getting ahead of yourself too. But
Right, and you know what? Both of those things are true. Everything that was just said about support turning into resistance, but also getting ahead of ourselves. We want to make sure that we bake the cake in order. We can't frost the cake before it's baked, right? Like that doesn't come out very well. We can't put the candles on the cake before we've made the batter. So let's keep going with this. Depth of the pattern. The depth of the pattern should really be 40% max. About 40% max. And if something is, say, 45%, I wouldn't throw it in the trash straight away. I would go and check, well, what was going on during that particular period. Because if we're in the middle of COVID and something forms a VCP and the market's just dropped 30%, and I find a stock that's dropped 45%, but everything else is perfect, then I would probably still give that one consideration. But in general, 40%.
what do you mean depth of pattern?
So when I'm looking at this area right here, right? Well, what's the deepest point of the pattern? For Netflix, the deepest point, if I measure from here to the bottom of this, it was 22%.
What do you call that initial point that you measure the depth from?
Top of the base?
Yeah, well, you have to determine that's a base, but yeah, okay. Because you can't, you're not going to measure that immediately. It's going to take a couple days to see it, and then you're like, okay, this is the base.
Well, no. So when I'm spotting this, right, maybe this is starting to come on my radar over here, right? And it's just like, oh, look, this is starting to round something out. Or maybe I might have even saw this first one back here, right? Because remember earlier when you guys were saying, oh, that looks just like a double bottom. Yeah, I probably saw this as a double bottom too. And so I would have measured that point, and it would have been like, okay, yeah, it's 20% deep. But the point that I'm trying to make is that I'm not measuring it like on this day. I'm not measuring it over here. I'm measuring it when I've identified a pattern that's in my business plan. And that's something that I've mentioned the term business plan a number of times on various streams, but that's a very important topic that I'm actually starting to work on another book on. Writing a business plan for your trading.
Mike, the depth is 40%. Is there anything that the depth tells you if it's like 10 to 15%? Like, what else does the depth tell you other than 40%?
All right. That's a fair point too. What's the minimum? So I would say that the minimum should be... The minimum that I would want to trade would probably be 15% min to 40% max. And the reason why I'm giving myself that range is because if it's too shallow, then it tends to be too slow of a mover. So let's just say, for example, that we're looking at Nvidia again. Right, so let's
too deep, too much volatility, too shallow, not enough energy.
Right. Right, exactly. So if we're over here, and this whole thing for 3 months, 4 months is only 15% deep, uh, it's far less likely to give you this kind of a move. And you're probably not going to see a PDR where you have 3, 4, 5% on average per day for most of this, and in some spots you have larger than that. I want stocks that have a certain level of volatility built into them because those are the type of stocks that can give me the type of returns that I'm looking for. I could find VCPs in stocks that move 1% per day, but those aren't the types of stocks that give me the type of returns that I'm looking for. And that's how, even though VCPs can occur, right? Like somebody, and Mark might have his definition of what he's looking for. I might have mine. Somebody else comes along. They observe that, yeah, you know what? I see the same kind of volatility contraction happening in a Forex pair. And Forex doesn't move like a stock, right? But you might still be able to trade it that way, and they'd be able to accept something that moves just a couple of percent per week because they're trading different way and they're sizing differently. So we all want to come up with our own definitions for how we're going to fill in this template. Use what I have here as a base, feel free to, but you're definitely going to want to customize it. So depth near the pivot. Let me explain what this is because I think that this gets confused a little bit. For me, depth near the pivot is where I'm looking to buy. So over here, right, I'm looking to buy this. I want to buy that breakout. So if I'm looking to buy that breakout, where do I need to place my stop in order for my stop to be below price structure? In order for my stop to be below price structure, I need to be placing my stop right below here. That's where structure is. And how do I know that that's where structure is? Because price rounded out that part and then broke through. So if price is breaking out here, it has the ability to pull back in, but it shouldn't fall through the floor. If it falls through that floor, that's no good. And then all of a sudden, price is no longer getting, volatility is no longer contracting. Now volatility is widening, right? Because now we went up here and now we're back below this. For this entire thing, price got less and less and less volatile. So for this point over here, I really want price to be less than, I'll say, 8% maximum. Ideally, it's less. As far as a minimum, I'd say 3%.
8% maximum from what was the point top to the point bottom again? You showed on the chart.
Where I'm looking to enter versus where, so from resistance to support. So where I have that pivot line, that's resistance. I'm buying this as a breakout trader, right? So price is breaking out of the pattern. I'm looking to buy right there. The support level is right down here.
Yeah, so, support level is at 475.
The support level here is that low right there. That's 473.18. So the way that I set this up would be like, okay, I want to buy a little bit above resistance and have my stop a little bit below support. So that's why over here, I don't know if you could see that or if the font is too small. I have the entry at 504.60 and the stop at 472.90.
Got you. Yeah. 513. Yeah. Okay.
Now, there's a whole bunch of other stuff going on the chart, and you probably, you guys have been with us for a little while, so I'm sure that you've already picked up on several different things. We'll get to all the other things that are going on the chart when we get over to this section here, right, with all the different boosters, right? Like that's really where the rubber meets the road for making our model books. Right, we want to have the base minimum, but we don't want to just buy the minimum criteria, right? Well, we want to buy the high end stuff. So let's continue. Look and character, right? Well, what would you say the look and the character is of a VCP based on what you've seen so far?
Contracting volatility, maybe a drop in a tightening of range, maybe a drop in volume.
Very good. So volatility is contracting from left and right. Volatility contracts several times.
Sorry, Mike. Also a retouching of the moving average.
Sometimes it touches the moving averages. Sometimes it doesn't.
Seems like, tell me if I'm wrong because you know this pattern better than mine, but it seems like it should bounce off something, right?
Yeah, it should, and that's actually something that I would include as a booster.
Okay.
As far as the things that it absolutely must have, otherwise, we'll toss in it immediately.
Well, it looks like it's in an uptrend prior to the base.
And that's what we're going to do right here. Placement in the
Right.
trend. So just to put it over here, stage 2 uptrends.
Mm-hmm. It's like a consolidation base building post a big move up.
Yeah,
Or
absolutely.
at least on this chart.
Yeah. Mark looks for part of Mark's qualifier is that it's in a stage 2 uptrend.
Mm-hmm.
And so since he was my mentor, I adopted that and it's worked pretty well. And VCPs in stage 2 uptrends work out pretty well. So volatility is contracting from left to right. Volatility contracts several times. I like to see at least 3. Sometimes, so if you kind of think about it, a cup with handle is a VCP. Right?
Yeah.
So, because here's what happens with the cup with handle, right? You have the cup, there's your first contraction, then you have the handle, the second contraction, and then it goes. If it's one that's going to work.
So it's a short VCP.
Right.
Well, a rocket base also is a VCP.
And so this is where we want to have models of what it is that we're looking at versus we want to have models of what we're looking at. So that way we could more easily identify, does this fit what I'm looking for, yes or no? Because lots of patterns have volatility contraction action in them, but may not necessarily be what we would call as a VCP.
Mm-hmm.
All right, so let's see. Well, what else do we have here? So volatility is contracting from left to right. Volatility contracts several times, at least 3.
Mike, do you have any thoughts on if the depth of pattern is more than 40%, but it eventually contracts into 40% reasonably, meaning that originally the drop might be 60, but then over a period of time it contracts into 40 and then begins to show all the other characteristics of the VCP?
Generally, if something drops that much, like 60%, most of the time it ends up being a flawed pattern and more failure prone. So it's not to say that something that drops 60% or more can never come back. It just has significantly more work to do. And by the time it does that work, it's gone through other types of consolidations where you could end up disregarding that 60% drop it and focus more on what it's doing over the last, say, 5 or 8 weeks.
Okay.
I believe Netflix qualifies as that at various points, right? Like over here. How
Sure,
deep was this? Right between this, right? There's a 70% drop. So over here, you might look at this. Oh, you know what? Yeah, this is such a good example. Oh, look at this. There's a contraction and here's a contraction. May add that it's a little wide, but that's okay. You have this little contraction over here. Let's buy as it's getting back through the 200. Wrong.
Yeah.
And how would we know that it's wrong? Well, if we take a look at our must-haves, is it in a stage 2 uptrend? No. Right? It's well below the 50. It's below the 200. The 200-day is in a downtrend. And so right there, you would write this off. Something else that would disqualify it for me is time below the pivot. I wouldn't use this. That's only 2 days. But by the time you finally get to a point where this thing becomes buyable, maybe you start looking, I don't know, somewhere in this vicinity. You could have bought something like that. But for this point, you're ready in. And that I said, yeah, I thought I might have said Netflix, but Nvidia dropped 70%.
Yeah.
And it took
That was
how
COVID,
long?
right? Or no, one COVID.
Yeah. Yeah, this was November 21. Yeah, so after.
Yeah, wow.
Yeah, big bear market, and then finally comes out of it, and then becomes buyable again over here. A long time later.
It's interesting because at December 14th, a person could describe that as a stage 2 uptrend because it was above all the moving averages, but then
December
it dropped.
14th of what? Of what year?
Of 2000. Let me see. Of 2022, I think.
Yeah.
December 14th.
Yeah, and at the beginning of 23, the price action is way above the MAs. The 50's trending
right
up
there.
above the 200.
Well, no, that's not a stage 2 uptrend because the 200-day is in a downtrend.
No.
In order to be in a stage 2 uptrend, you need both the 50 and the 200-day moving average to be pointed up. That starts to happen over here.
March, okay.
Okay. So the stage 2, it's like, yeah, it's a downtrend, but it's like slightly downtrend.
Right.
Okay, interesting.
So the fact that the 50 crossed through the 200 in January, that is irrelevant.
That's irrelevant. That's the start of something maybe, but you don't get into stage 2 until over here. And all this, and that doesn't mean that this somebody that's making money over here, right?
Yeah.
But the point of all this is focus. And the point of all of it is to stack odds. How do you stack
It's
the
actually
odds?
yeah.
Well, you stack
So it's
the
like
odds by
Polaroid.
putting yourself into position when price is going up, and by focus. If you're willing to just buy anything, then you'll have more opportunities, but you'll also have a lot of those opportunities will flop. So we want to be precise with when we're going to buy.
Right. Process, rules, discipline, and patience.
Exactly, and that's what this is getting at. Building out something like this. Now, the market type required. For me, it's generally the same thing all the time. It's going to be uptrend or sideways. For
A good one.
daily, weekly, and monthly.
Is there a way? Is there some sort of indicator that can tell you if the 200 is in an uptrend? Because sometimes it's very subtle, right? I mean, when it's obvious, but sometimes it's subtle.
Yeah, the indicator itself, you just roll your mouse over, and it'll tell you where price is at. Right. So right now, so I'm looking at this right here. Right, so keep your eyes on this, and maybe you could see it easily, and maybe not. But as I roll my mouse over, you could see the price. So over here, price is 163.38. Over here, price is 163.68. So on this day, February 28th, it's going up, and that's how you could tell if it's in an uptrend. Very simple.
Real quick, how did you see the price again?
It's right
Like,
there.
I can see it.
It's where my mouse is, right? When I roll my mouse over this, these other options pop up. But when I take my mouse off of that, you'll see a price.
Ah, okay, great. Yeah, perfect. Yeah, that's great. So, but how do you know if it's in an uptrend at that point?
What the price was today versus what it was yesterday. If it's higher, it's in an uptrend. If it's lower, it's not.
Yeah, but that means that the price is higher. If the price is higher than the 200-day, it's in an uptrend.
This is the price of the 200-day. That's where the 200-day moving average is at. So if say price is at 600 today, tomorrow it's at 601. The day after that, it's at 602. That's the moving average. So the moving average is going up. But if you saw, today it's 600, tomorrow it's at 598, the day after that it's at 595, then is price going up or down?
Right. I see what you're talking about now. Yeah, you're talking about the price of the moving average is higher than the day before. I thought you said the price of the stock is higher than the moving average. You're saying the price of the moving average is higher each day.
Right.
Yes,
right.
I understand that.
Okay, so we want the market type to be in uptrend, sideways, uptrend to sideways for daily, weekly, and monthly. And so that's what I'm looking for. As far as the boosters go, and then I just noticed that we're already about 10 minutes over. So if you've got a scoot, no hard feelings, but if not, we'll keep rolling. So here are some of the things that I look for, and I'll pull up these examples here. So that way we're just looking at static images and it pops up a lot quicker. So I have an example from 24, 23, and 2009. All right, so here we had Nvidia. We saw that one a bunch already. We took a look at this one in Netflix. I also want to take a look at this one here in GRBK, Green Brick Partners. Now, this one here is a little bit different, right? What's different about it?
It looks like it's an ascending base.
Yeah. Sometimes that happens too, right? So you're not just here, right? Because what'll happen sometimes is price will round out, and then it'll round out again, move slightly higher, and then it'll contract a little bit more, and then it'll contract again. And sometimes these are the types of patterns that tend to wear people out. And like, let's say that you're somebody that bought in over here, like as it was starting to break above these highs, and then it starts to do this. It might be like, it's not going anywhere. And then it starts to come back. You might be like, I'm not getting burned on this one again. And then it goes off and does great things.
The curious thing about this one is that compared to the other two, it never breaks the 50-day whatsoever. The others
Sometimes
do.
that happens. Sometimes it doesn't.
Yeah.
And that's some of the nuances of the pattern. And that's why it's important to have multiple models. Right? You want to have models where they meet your baseline. They should have they meet your baseline and they worked. Right? Like let those be the first two things that you look for the model, that they have all of your must-haves, and that when they broke out, they did something like this versus like they broke out, they failed, and then, maybe 3 or 4 weeks later that they had a 100% move. You want to model the ones that work.
Yeah, because
this should also...
Here it breaks out of that pivot, but then it sort of flatlines for about 2 or 3 weeks, and then it really goes.
Sure. So, with this one, it's not that this one didn't work at all. Well, when I say didn't work, I mean it hit your backstop or it hit your stop loss. This one never fell below the stop loss.
Yeah.
Right, and the stop loss, if we're keeping it below structure, it's this contraction right there. It never fell below that.
Sure.
So, what else was I going to say? What you also want to do when you're looking for patterns that you're going to model, go through the examples that I have. I have them all in that setups tab of the playbook. Go through other books, right? Go through my books, go through O'Neill's books, go through Minervini's books, others where you know that the information is good and that you're getting great models. And then that'll help train you for what to look for, and then you'll be in a much better position to go and find them on your own. And when you do find the models, you want to put it into your platform. You want to put it like I'm a huge fan of TradingView. I like to put everything into TradingView. And so, some of these, right? Like the Netflix example, this is one that I got from Mark. But when I put it into TradingView, I'm able to go and see, oh yeah, you know what? Here's some of the things that it did. It had a reversal off the 21 EMA, right here before breaking out. It broke out. It was setting up ahead of earnings, and it broke out on earnings. So just because something is setting up ahead of earnings, that doesn't mean that you shouldn't look at it. Because if it breaks out on earnings, sometimes on earnings you get a price gapping up all the way up here, and then you can't do much with it because the reward to risk is all out of whack. Especially if you want to try to place a stop down here, it makes it a little bit more difficult. But if price reports earnings and comes up through the pivot like it did right here, then that gives you an opportunity to get in where more likely than not you're going to end up with monster volume, right? Because it's earnings. So that happened on this one, and all this that I wrote out, that's not what I'm looking for. I'm just observing, well, what happened on this model. And that's what I would encourage you to do too. When you have your model and you have it in your platform, you'll have all your regular indicators up. So what sort of things do you observe? Sometimes you'll find things that are positive. Sometimes you'll find things that are negative, right? So to continue with this one, it broke out on earnings. breaks out with massive volume. Volume ended up solving the following, right? It solved relative strength line lagging the price, and it also solved the stochastics being negative, because ahead of the breakout, you're in that zone, right? Where the stochastics are kind of iffy. And that's good to have for your models too, so that way we're not dumping a stock like this because of one or two things that aren't completely perfect. So we saw a few different examples here. We have our definitions. We now have the definition added to our setup book in the playbook. If I can find where the playbook ran off to. It was in here. Yeah, just I'll add these boosters, right, because many of the boosters that I look for tend to be similar. But that's why these are boosters. They're things that I would like it to have, but it's not things that would necessarily make it disqualify it. Right. Well, one of the things that I would also want to add to this is that it's a leader. Current or
And for you, there's no booster related to volume.
Well, that it should have volume declining. That was a must-have.
Okay.
And the volume increase on the breakout?
So volatility is contracting from left to right. Volatility contracts several times. Volume should also declining on declines, and volume increasing on upswings. Right, so to go back to one of these examples here. So if volume over here, right, like if there were some really big volume spikes up here in this section, that would rule us out. What we want to see with any VCP is that it's not just the price that has the volatility contracting, the volume should also be contracting, especially when you're getting towards the very end. And you'll see that that's the case on each of these. Even this one, right ahead of earnings, volume is pretty low. And it could be even just the last couple of days, just before it's done. Right, look how low volume is. That volume is like half of what it normally is. That line right there, that line is about, that's the 50-day average volume. So you're about half of what the 50-day average volume is. So all right, I think that's about it. Any other questions before we wrap things up?
No, really good presentation.
Thanks, Mike.
You're welcome.
Thanks, Mike. Really
You're very, very welcome. All right, guys, I'll see you next time. Have a great rest of your day.